Bismillahirrahmanirrahim. Assalamu alaikum, dear students. Welcome back to my class. I hope everyone is fine and has gone through the videos of chapter 7 because the chapter 8 is closely related to the chapter 7. In chapter 7, we learn how to calculate rate of return for single project, and in chapter 8 we're going to learn how to do rate of return analysis for multiple alternatives or more than one project. So the basics will be the same, but we need to extend those techniques to more than one project. That's why uh, it is very important to understand chapter 7 before coming to chapter 8. Let's go through the contents of the chapter 8. First of all, we'll understand why incremental analysis is required in rate of return analysis. Then incremental cash flow calculations, how we can calculate incremental cash flows. Then interpretation of rate of return on incremental cash flows. Then the next topic will be how to select alternatives by rate of return based on present worth relation, and how to select alternative by rate of return analysis based on annual worth relation. Finally, how to select best from several alternatives using rate of return method. Let's start with understanding why incremental analysis is necessary. Under some circumstances, project rate of return values do not provide the same ranking of alternatives as do present worth and annual worth analysis. In these cases, we need to perform incremental analysis to reach a good conclusion about the selection of project. In such cases, we need to do incremental rate of return analysis to avoid ranking inconsistency problem, means to select consistently the best possible project. Before doing incremental rate of return analysis from multiple alternatives, one need to learn how to calculate incremental cash flows. So here is a demonstration of how to calculate incremental cash flows. So what does the incremental cash flow shows? So incremental cash flows shows how much additional investment is required to move from a low cost project to a high cost project. So for example, here we have two projects A and B. First cost of project is 40,000, B is 60,000. Annual cost of A is 25,000 and B is 19,000. And salvage value of A is 8,000 and B is 10,000. Now, if we want to shuffle from project A to B, we need to calculate its incremental cost to know how much extra investment is required to move from A to B. So in terms of initial cost, we need 20,000 more to shuffle from A to B. And when it comes to annual cost, we can save 6,000 per year by shuffling to project B from A, because the annual cost of project A is $25,000 and B is $19,000. Similarly, we can get 2,000 more in terms of salvage value at the end of the life of B, because the salvage value of B is 10,000 and A is 8,000. So we can get 2,000 extra in terms of salvage value. So incremental cash flows shows the extra investment or cost required if an alternative with higher initial cost is selected. So if we select option B rather than A, we need to invest 20,000 extra upfront, and then we can save 6,000 per annum in terms of annual expenditures, and we can have an additional cash inflow of 2,000 at the end of the life of B. In incremental ROR analysis, we analyze the rate of return earned on the extra funds. Mean in case of incremental analysis, we'll use these values to calculate rate of return rather than these values. If return on extra funds is justified, we select the alternative, the one with higher initial cost. Otherwise, not. Instead, we select the cheaper one. If justified, we'll select B, otherwise we'll stick to A. Because firm can save this extra cost and can invest at higher rate somewhere else to earn some money. Then why incremental analysis is necessary? Selecting the alternative with higher rate of return may not yield highest return on available capital. So here is an example that will clarify why incremental analysis is necessary. Because it is not possible that if you select a project with higher ROR and it will give you the highest return on your capital. For doing so, you need to calculate weighted average of total capital available. Capital not invested in a project is assumed to earn at MARR, which is minimum attractive rate of return, because any firm wouldn't allow a financial manager to leave financial resources idle. If they have something, they would try to invest in a project that will give them at least MARR after supporting their operations. For example, assume 90,000 is available for investment in two mutually exclusive projects, and minimum attractive rate of return is 16% per year. If alternative A would earn 35% per year on investment of $50,000, and B would earn 29% per year on investment of $85,000. So if we have 90,000 available for investment, minimum attractive rate of return is 60%. Project A is giving 35% per year on investment of 50,000, and project B is giving 29% per year on investment of 85,000. So on the basis of rate of return of individual project, the rate of return of A is higher than B. So on the basis of these values, one would select obviously alternative A over alternative B, because it is giving 35% rate of return rather than 29% rate of return. Now let's see whether the selection of project A is better, project B is better on the basis of overall rate of return, because we have to account for the idle funds that may earn at least minimum attractive rate of return, that is 16%. Now let's calculate the weighted averages. Overall rate of return of project A will be 50,000, that if invested will earn 35% per year. So 50,000 multiplied by 0.35 plus remaining 40,000 that can be invested at minimum attractive rate of return, that is 16%. Divided by 90,000, so the overall rate of return for project A should be 26.6%. And project B 85,000 at 29%. And remaining 5,000 at 16%, divided by total amount available for investment. So the rate of return is 28.3%. So overall rate of return for B is 28.3% and A is 26.6%. So which investment is better economically now? Obviously now, if we consider overall rate of return, then B looks better than A, and one should select B. And if we should have focused only on rate of return of individual projects, not overall rate of return, then one should select it A, and that would be a misleading choice. So if selection basis is higher ROR, we should have selected alternative A, which is wrong choice or wrong answer. And if selection basis is higher overall ROR, then we should have selected alternative B, which is a good choice. And the conclusion of the discussion is that one must use an incremental ROR analysis to make a consistently correct selection. Unlike present worth, annual worth, and future worth values, if not analyzed correctly, rate of return values can lead to an incorrect alternative selection. This is called the ranking and inconsistency problem. Hope it's clear to everyone why conducting incremental analysis is necessary. in rate of return analysis. Now, the interpretation of rate of return on extra investment. Based on the concept that any avoidable investment that doesn't yield at least the MARR shouldn't be made, because companies always required at least minimum attractive rate of return that they can meet their expenditures or cost of capital. Once a lower cost alternative has been economically justified, the rate of return on extra investment, for example, additional amount of money associated with a higher first cost alternative, must also yield a rate of return that is greater than or equal to MARR. Because the extra investment is avoidable by selecting the economically justified lower cost alternative, means you can save those funds by investing in cheaper project or cheaper alternative. This incremental rate of return is identified as delta Oyster. For independent projects, we can select all projects that have rate of return greater than or equal to MARR. And in case of independent projects, no incremental analysis is necessary. Incremental analysis is only required in case of mutually exclusive alternatives or projects. And in case of independent projects, incremental analysis is not required. Now, problems with applying rate of return for evaluation of multiple alternatives. There are three primary elements due to which mainly rate of return analysis are applied incorrectly in engineering economic analysis. First of all, incremental cash flow series. If you ignore incremental cash flow analysis while evaluating mutually exclusive alternatives, your answer will be incorrect. Second, least common multiple. So you need to always satisfy the assumption of equal life service of projects. So if a project has 3 years life, other has 6 years or 9 years, then you need to calculate least common multiple and make calculations on the basis of least common multiple of lives. Otherwise, your calculations will be incorrect. And third, multiple routes or multiple ROR values. In that case, if you find out that you have a problem of multiple routes or multiple ROR values, it is advisable to use present worth or annual worth analysis instead of rate of return to avoid multiple ROR values problem. Then ROR evaluation using present worth. Just recall calculating rate of return for single alternative as we did in previous chapter. What you do, you take present worth and equate it to 0 to start with. Similarly, present worth based relation is developed for the incremental cash flows and set equal to 0. Using trial and error approach, calculate the incremental rate of return at which present worth of incremental cash flows is equal to 0. Then equal life comparison by using LCM method, you need to satisfy this assumption as well. Then rate of return evaluation for two mutually exclusive alternatives. First of all, we have to order alternatives by increasing initial investment cost. Second, we have to develop incremental cash flow series by using LCM of years. Third, we have to draw incremental cash flow diagram if needed. Fourth, we need to count sign changes to see if multiple values, multiple rate of return values exist. So we can use Decker's rule of sign or Nostrum criterion to count sign changes. Fifth, we have to set up present worth, annual worth, or future worth is equal to 0 relation and find incremental rate of return. Note, incremental rate of return analysis requires equal service comparison. The LCM of lives must be used in the relation as I explained earlier. If incremental rate of return is less than MARR, we will select the cheaper project. And if incremental rate of return is greater than MARR, we can select the project with the higher initial cost. If multiple IRR values exist, find error using either modified rate of return or return on invested capital approach and calculate external rate of return. Here, error means external rate of return. ROR evaluation using annual worth. Just recall calculating internal rate of return or rate of return for single alternative. You take present worth or annual worth and equate it to 0 to start with. Like present worth based relation developed for the incremental cash flows, annual worth based relation can be developed for the incremental cash flows and set up equal to 0. Set the equation equal to 0. Here I'm going to skip this method because it provides same results as based on present worth. The purpose of just discussing it to let you know the presence of this alternative as well. Otherwise, everything is equal to this method. Rather than present worth, you will write annual worth, and everything else will be equal. Even you get the same result by using both methods. Let's take an example of incremental ROR evaluation. Either of the cost alternatives shown below can be used in a chemical refining process if the company's minimum attractive rate of return is 15% per year. We need to determine which should be selected based on rate of return analysis. Here we have two projects, Project A and Project B. First cost of Project A is $40,000 and B is $60,000. And annual cost of A is $25,000 and B is $19,000. Salvage value of A is $8,000 and B is $10,000. Life of both options is 5 years. So the initial observation is that these are mutually exclusive alternatives. Only one of them can be selected. And these are cost alternatives, not revenue alternatives. And life of both alternatives is also equal. And no multiple ROR values are indicated. Now let's go to the solution. Solution using procedures. First of all, we need to order by first cost and find incremental cash flow, which is B minus A. So A is the lowest cost option, B is the highest cost option. So we need to calculate incremental cash flows first. So the initial incremental first cost will be 60,000 and 40,000. Difference of 60,000 and 40,000, that is 20,000 more. And in terms of annual cost of A is 25,000, B is 19,000. Means we can save 6,000 per year if we opt for project B rather than A. When salvage value of A is 8,000 and B is 10,000. Difference is 2,000, means we can have additional 2,000 in terms of salvage value at the end of the life of project B. So these are our incremental cash flows, B minus A. Now the next step will be to write ROR equation in terms of present worth, annual worth, or future worth on the basis of incremental cash flows. So this is the present amount and these are future amounts. So 0 is equal to minus 20,000 plus 6,000. P over A factor for incremental rate of return, that is unknown, and number of years are 5. Then 2,000 is coming at the end of 5th year and we need to convert it at present time. So we'll use P over F factor for unknown rate of interest and number of years are 5. Now solve for incremental rate of interest and compare to MARR. Now I'm not going to interpolate because I have explained this process in previous chapter. I will write the value of incremental rate of interest that is calculated directly and we'll compare it with MARR to see which option is more suitable. So rate of interest is 17.2%, which is greater than MARR. It means that higher investment or more initial investment in project B is justified on the basis of incremental rate of return. Clear? Because incremental rate of return is 17.2%, which is higher than MARR of 15%. So rate of return on $20,000 extra investment is acceptable, and we are going to select project B. Now here is another example. We need to determine which of the two alternatives should be selected by calculating the rate of return on the incremental investment. On the incremental investment, keep in mind, assume the company's MARR is 21% per year. Both alternatives individually are viable based on internal rate of return. So first cost of project A is minus $50,000, B is $95,000, annual cost is $100,000, and of A and B is $85,000, and salvage value of A is 5,000 and B is 11,000. Life of A is 3 years and B is 6 years. Now we have to satisfy the assumption of equal service life. Equal life service assumption we need to satisfy. So the life of A is 3 years, B is 6 years. In that case, we need to calculate least common multiple of lives. So the least common multiple of 3 and 6 will be 6. It means at the end of third year, we have to repurchase the machine A or project A to justify or satisfy the equal service life assumption. Let's go to the solution now. First, we have to calculate incremental cash flow. Second, we need to check sign change of incremental cash flow. And then third step will be to write its present worth relationship. So here we have cash flows and incremental cash flows. For project A at time 0, when we'll purchase 50,000 outflow and 100,000 are annual expenditure every year for project A. So at the end of year 1, 100,000 outflow, at the end of year 2, 100,000 outflow, and at the end of year 3, 145,000 outflows. Why? Because at the end of the third year, we have to repurchase that machine, whose cost is 50,000. 50,000, the cost of repurchasing, and 100,000 annual expenditure. 150,000 in total, and 5,000 in terms of salvage value that we will recover. And net cash flow will be 150 minus 5,000. So net cash flows at the end of third year will be 145. And again, in fourth and fifth year, annual expenditures 100,000, and sixth year, annual expenditures will be 100,000, but we'll have a cash inflow of 5,000 in terms of salvage value. So the net cash flow value will be 95,000 outflows. And for project B, the initial cost is 95,000 at time 0 and $85,000 annual expenditures every year from year 1 to year 6. But at the end, in year 6, we have here 74,000 because we need to account for the salvage value, that is 11,000. So 85 minus 11, 74,000 will be net cash flows at the end of 6th year for project B. Now, once having calculated the net cash flows for both options, we can calculate incremental cash flows by taking the difference of both projects, B minus A. So at time 0, we have to pay 45,000 extra from shuffling to option B from option A. Then in terms of annual expenditures, we can save 15,000 in year 1 and 2. And again, we can save 60,000 in year 3 because this machine is being repurchased and cost is being added. And then in year 4 and 5 we can save 15,000 again, that is difference of 185. And in year 6 we can save 21,000, which is difference between 95 and 74. Once we have incremental cash flows, now we can set up the equation that would be minus 45,000 plus 15,000 P over A factor, P over A factor for incremental rate of return and 6 years. Then 60,000 minus 15,000, 45,000 remaining at the end of third year. That will be converted at time 0 by using P over F factor for 3 years. And here 6,000 will be remaining at 6 years. That is difference between 21,000 and 15,000. P over F factor for incremental rate of return and 6 years. Now here is the question, why we have used 15,000 from year 1 to 6 as an annual series of payments. Because if you see, 15,000 is common amount in every year. So we have considered 15,000 as an annual series of payment of 6 years, and the difference if at any year is being dealt as a single payment. So here we have 60,000 at the end of third year. So difference of 60 and 15 is 45. Remaining 45 is being dealt as single amount. And then again 21 minus 15, the difference is 6,000, which is again being dealt as single amount and converted at present worth at time 0 by using P over F factor for 6 years. Now, after setting up the equation, we can solve it for incremental rate of return using trial and error method. So the rate of return will be 42.5%, which is greater than minimum attractive rate of return. It means higher initial investment in project B is justified, and we can select alternative B over alternative A. I hope this is clear for everyone how to calculate incremental rate of return by using incremental cash flows for mutually exclusive alternatives. If you have any question, you can send me your queries and I will try to respond them as soon as possible. That's all for this lecture, and we'll see you with next lecture. Allah Hafiz, take care, stay safe.